2025, maybe the year of the bond. Bonds look attractive now because yields are high. Investors have wanted higher yields for a long period of time. They finally have them. The administration is really taking a pro-growth policy, which can be good for equities, and sometimes that's not necessarily good for fixed income. We're going to have to keep an eye on deficit spending. We're going to have to keep an eye on tariffs and what's happening overall for the global economy. But it is very important to note that corporate debt should do well in this environment because the economy is so strong now, and it's being supported going forward by the administration.
In 2024, the U.S. economy outpaced expectations, growing by 2.5%. At the same time, the Federal Reserve cut rates 3 times in the fall, helping to fuel growth. According to JP Morgan's credit team, this is putting upward pressure on yields.
You're looking at yields across the curve that are attractive and at levels that you have not seen for 10, 15, 20 years in some instances. So it's very easy to find yield. It's a little more difficult to find spread. Spread is the amount of incremental yield that you're getting over a treasury, over a global government bond that's risk-free. However, these spreads are low right now, or tight as we might call them, because the economy is doing well, because there's significant demand for corporate credit. As we go into 2025, it's important to note that the Federal Reserve will probably still cut 1 or 2 times, but this may or may not drive all the yield curve lower. That'll be dependent on overall inflationary expectations, the global growth, as well as the U.S. domestic growth.
With the Trump administration's America First mentality, experts say there are certain sectors in the bond market that stand to benefit.
U.S. high yield, U.S. investment grade is very U.S.-centric and going to be participating in the growth going forward of the U.S. economy. We're finding attractive yields there. We're finding them particularly in the banks that are a derivative of the economy and will benefit from less regulation going forward. We're also finding them in utilities, which are a beneficiary of the AI revolution going on in the United States right now. We have some concerns, however, around the energy portion, E&P companies that are drilling. Drilling might be good for the consumer, might be good to drive gas prices lower. However, these companies reliant upon higher energy prices, so it may or may not be a good thing for those particular credits.
In 2024, investment-grade companies issued about $1.6 trillion in debt through December 10th, which is a 27% increase from the same period in 2023 and the highest level since 2020. While the economy remains strong, tariffs and inflation could cause volatility in credit markets.
Investors should consider BBB-rated investment-grade bonds. They're the highest yielding portion of the investment-grade market. In addition to that, BB-rated high yield, we also think is very attractive. The U.S. auto industry, which are generically rated BBB or BB. These autos and more consumer cyclical credits will be tied to the growth of the U.S. economy. We'll be doing very well from here. There are 2 main risks to the credit markets currently. One would be a hard stop or a hard landing to the U.S. economy. The other would actually be the opposite, which is the U.S. economy accelerating too fast, causing too much inflation, causing the Federal Reserve to actually hike rates rather than cut like the current market is expecting. However, in a Fed hiking, the economy going too fast, that would be bad for credit markets over the near term. Longer term, we do think the U.S. economy is on strong footing, and we think that there is a very low tail risk scenario, and we think that the high amount of yield that you're receiving currently by the market more than offsets these current risks.